Something important is happening beneath the surface of the financial system, and most people are still treating it as if it is just another noisy headline. The dollar is weakening, oil prices are rising, inflation pressure is returning in places people thought had already cooled. And for the first time in modern history, the United States is not simply dealing with another market cycle. It is dealing with a gradual change in the structure of global trade, global money, and global power. That is the part most investors miss. They see a bad year for the dollar and they think it is a currency story. They see China settling more trade outside the dollar and they think it is a political story. They see central banks buying gold and they think it is a commodity story. They see emerging markets growing faster and they think it is just another diversification argument. But when you put all of these pieces together, you see something much more important. You see a world that is slowly moving from one dominant financial system into a more fragmented, more competitive, more multipolar system. That kind of shift does not happen. Often when it does happen, it creates two things at the same time. It creates large risks for people who assume the old system will last forever. And it creates large opportunities for people who understand that power, money, trade, debt, and productivity all move in long cycles. I have studied these cycles for most of my life. I have seen how countries rise when they have strong balance sheets, strong productivity, strong education, strong internal order, and strong reserve currencies. I have also seen how countries lose ground when debts rise faster than income, when money is printed to cover gaps, when internal conflict increases, and when other powers become strong enough to challenge the system that used to be taken for granted. This is not a panic story. It is not a story about the dollar disappearing tomorrow. That is not how reserve currencies usually lose power. They do not usually collapse in one dramatic moment. They dilute, they weaken, they lose share, they become less central to the system, then the cost of maintaining dominance rises, then investors who were over-concentrated in yesterday's winter begin to feel the consequences. That is the important distinction. A collapse is fast, a dilution is slow. A collapse makes headlines. A dilution changes the returns you earn for the next 10 or 20 years. And that is why this matters for your money. For the last several decades, the easy answer for many American investors was simple. Put most of your money in the United States, own the S&P 500, own the large technology companies, trust the dollar, trust the depth of the American capital markets. Trust that the United States would remain the strongest economy, the most innovative economy in the center of the financial system for a long time. That was not a foolish approach. It worked very well. The United States had the deepest markets, the most trusted institutions, the most liquid debt market, the strongest technology companies, and the reserve currency the rest of the world needed. That combination gave the United States what economists call an extraordinary privilege. The United States could borrow cheaply, it could run large deficits, it could print money more easily than other countries, it could export dollars to the rest of the world and receive real goods, real services, and real investment in return. Other countries held the dollar because they needed it for trade, oil, debt settlement, reserves, and safety. That system did not happen by accident. It came out of the outcome of the Second World War. When the war ended, the United States had the strongest economy, the strongest industrial base, the strongest military, and the most credible financial system. The dollar became the center of global reserves because the United States had earned that position through strength. But strength changes over time. Debt changes over time. Productivity changes over time. Demographics change over time, military commitments change over time, and when other countries become larger, richer, more coordinated, and less willing to live inside a system dominated by one country, the old structure begins to shift. That is what we are watching now. The BRICS countries and the broader non-Western world now represent a much larger share of global output than they did a generation ago. China, India, Brazil, Russia, South Africa, the Gulf states, and many other emerging economies are not small side players anymore. They are a large and growing part of global production, consumption, energy, minerals, and trade. At the same time, the share of global foreign exchange reserves held in dollars has been declining. That does not mean the dollar is dead. It means the dollar is losing monopoly power. There's a big difference. Central banks around the world still hold large amounts of dollars, but the direction matters. The dollar share has been drifting lower. It is not a straight line. It is not the same in every country, but when the same trend appears in reserves, trade settlement, gold purchases, and alternative payment systems, I pay attention. When I look at a system, I do not ask whether one number on one day proves the entire thesis. I ask whether the incentives are changing, and the incentives are changing. For many years, foreign governments were comfortable holding large amounts of U.S. Treasury securities because they believed dollars were safe, liquid, and politically neutral enough for reserve purposes. Then the United States and its allies froze Russian reserves after the invasion of Ukraine. Whatever one thinks of that decision morally or politically, It had a mechanical effect on the system. Every country that was not closely aligned with the United States had to ask a simple question. Could that happen to us? If the answer is yes, then the rational response is to reduce dependence on the dollar, reduce dependence on U.S. financial infrastructure, increase holdings of neutral assets, and build payment rails that can continue operating even if access to the Western system is restricted. That is not ideology, that is risk management. Countries manage risk the same way disciplined investors manage risk. They look at dependency, they look at concentration, they look at what happens if the other side controls the switch, then they diversify before the switch is ever pulled. That is why China has reduced the share of its reserves held in U.S. treasuries. That is why central banks have been buying gold. That is why countries are experimenting with bilateral trade settlement in local currencies. That is why payment systems outside of the dollar and outside of the Western-controlled messaging system are being developed. That is why the digital yuan, cross-border payment networks, BRICS settlement ideas, gold-backed proposals, and blockchain-based central bank settlement projects all matter, even if none of them is yet strong enough to replace the dollar. Most people make the mistake of thinking a challenger must replace the dollar completely in order to matter. That is not how these transitions work. A reserve currency can be weakened long before it is replaced. If 10% of a system moves away from the dollar, that matters. If 20% moves away, that matters more. If oil commodities, regional trade, central bank reserves, and payment networks become less dollar dependent, the United States still remains powerful, but it loses some of the advantage that came from being the only system everyone had to use that matters to investors. Because assets are priced based on expectations. If the expectation for the last 50 years was that U.S. assets deserve the highest allocation, the highest valuation, and the strongest currency support, then even a modest shift away from that expectation can change returns. The most dangerous thing in investing is not a bad headline. It is a widely held assumption that stops being true. For a long time, many American investors assumed that international diversification was unnecessary. The United States outperformed. The largest U.S. companies became global monopolies. The dollar stayed strong. The S&P 500 became the default portfolio for millions of people. That created wealth. It also created complacency. Today, the average American investor often has a very large share of wealth tied to U.S. markets, U.S. companies, U.S. currency, U.S. policy, and U.S. valuations. That is a concentration. Concentration is wonderful when the thing you own keeps winning. Concentration is dangerous when the environment changes. This is why the forecasts from large institutions are important, not because forecasts are perfect, but because they show how the expected return map is changing. Vanguard, JP Morgan, Fidelity, and other major institutions have been pointing to a similar issue. U.S. stocks have become expensive relative to many international markets. The largest U.S. companies dominate the index. The top 10 companies now represent a very large portion of the S&P 500. That concentration has made the index strong when those companies rise, but it also creates vulnerability if the future leadership broadens beyond them. At the same time, many international and emerging markets are starting from lower valuations and may have more room to grow. That is not a guarantee. Emerging markets can be volatile, they can have governance problems, they can have currency problems, they can have political risk, they can disappoint for long periods, but investing is not about certainty. It is about probabilities, price diversification, and not having all your future dependent on one outcome. If the United States continues to dominate, a U.S. heavy portfolio can still do well, but if the world becomes more balanced, if India grows into a much larger economic power, if emerging markets become a larger share of global stock market capitalization, if the dollar weakens gradually, and if U.S. valuations compress while foreign valuations rise, then investors who have no international exposure may find themselves underexposed to the next major source of global growth. That is the key point. The world is not getting smaller, the world is getting bigger. More people are entering the middle class, more countries are building capital markets, more regions are becoming technologically literate. More trade is happening outside the old Western framework, and more capital will eventually follow the places where growth, productivity, and valuation line up. India is one of the most important pieces of this. China has been the biggest story of the last several decades. But India may be one of the biggest stories of the next several decades. It has a huge population, a younger demographic profile, rising technological capability, and the possibility of becoming one of the largest economies in the world. That does not mean one should blindly buy anything with India in the name. Blind investing is still blind investing. But it does mean that a portfolio built entirely around the assumption that the United States will capture nearly all of the world's best returns may be too narrow for the world we are entering. The same is true for emerging markets more broadly. By the middle of this century, emerging markets may represent a much larger share of global equity markets than they do today. If that happens, global investors will have to adjust, whether they want to or not. Capital markets have a way of reflecting economic weight over long periods, even if there are long delays and painful setbacks. The investor who waits until the shift is obvious often pays a much higher price. That is one principle I have learned again and again. When something becomes obvious to everyone, the opportunity has usually changed. The right time to think about diversification is before you are forced to diversify. The right time to think about currency risk is before the currency becomes a crisis. The right time to think about geopolitical fragmentation is before the market prices it all in. That does not mean rushing. It means preparing. Preparation is different from prediction. Prediction says I know exactly what will happen. Preparation says I do not know exactly what will happen, so I will build a portfolio that can survive and benefit from more than one possible future. That is how I think about the dollar. I do not believe the dollar is going to vanish as the reserve currency in the near term. There is no immediate replacement that has the depth, liquidity, trust, rule of law, military backing, and capital market infrastructure that the dollar system still has. Europe has fragmentation and debt problems. China has capital controls and limited convertibility. Gold cannot settle global digital commerce at scale in real time. Bitcoin and other digital assets remain too volatile for most reserve purposes. The BRICS systems are important, but they are not yet deep enough or trusted enough to replace the dollar. So the dollar is not collapsing tomorrow, but it can still weaken over time. It can still lose share. It can still stop being the only game in town. The United States can still be the largest and most innovative economy while its relative dominance declines. That is what many people have trouble understanding. They think in extremes. Either America stays number one forever, or the dollar collapses. Either China takes over everything, or China fails. Either emerging markets are the future, or they are a trap. Good investing usually requires thinking in probabilities, not slogans. The more accurate way to think about this is that the United States remains extremely important, but the margin of dominance narrows. The dollar remains central, but less central. U.S. stocks remain valuable, but possibly less dominant. International markets remain risky, but possibly more rewarding at the right price. Gold remains unproductive, but useful as a neutral reserve asset in a world where governments can print money and sanctions can freeze financial claims. Commodities remain cyclical but important when the world is fragmenting, infrastructure is being rebuilt, emerging markets are growing, and supply shocks become more common. That is the system. When you see the system, you stop reacting emotionally to every headline. You begin asking better questions. What is the debt cycle doing? What is the currency cycle doing? Where are reserves moving? Where is productivity rising? Where are valuations expensive? Where are valuations reasonable? Where is capital overconcentrated? Where is capital underallocated? What happens if the dollar weakens? What happens if inflation remains higher than expected? What happens if U.S. exceptionalism continues? What happens if it fades? The goal is not to be perfectly right. The goal is to avoid being fatally wrong. That is why the practical response to this environment is not to sell everything in the United States. That would be too simple and probably wrong. The United States still has the world's deepest capital markets. It still has extraordinary innovation. It still leads in artificial intelligence, semiconductors, software, biotech, venture capital, and many of the industries that shape the future. When there is a crisis, capital still tends to flow into us assets because they are liquid and trusted. The dollar is still used in a very large share of global foreign exchange transactions and global payments. The U.S. Treasury market is still the largest and most important safe asset market in the world. So abandoning the United States would ignore reality. But going all in on the United States also ignores reality. A balanced investor does not need to choose between panic and complacency. The better approach is to adjust the mix. Keep a strong U.S. core because the United States still matters enormously. Add international developed markets because there are high-quality companies outside the United States that may be priced more reasonably. Add emerging markets carefully because growth may shift toward countries that are younger, faster growing, and underrepresented in many portfolios. Hold some exposure to assets that can do better when currencies weaken or inflation pressure returns. Consider gold or precious metals as a small hedge, not because they produce income, but because they are no one's liability and cannot be printed by a central bank. Consider commodities or commodity-linked assets in a measured way because a world of infrastructure, energy demand, emerging market growth, supply shocks, and currency dilution can create periods where real assets matter more. but always do this with humility. The biggest mistake people make after hearing a macro story is that they go from underprepared to overreacting. They hear that the dollar is weakening, so they want to sell all dollars. They hear that emerging markets may outperform, so they want to move everything into emerging markets. They hear that central banks are buying gold, so they want to become gold bugs. That is not strategy, that is emotional rotation. A good portfolio does not need to be dramatic, it needs to be resilient. The future is uncertain. That means the portfolio must be built to handle uncertainty, not to impress someone in a comment section. I would think about this in terms of buckets. There should be a core bucket that holds productive assets tied to the strongest companies and economies. There should be a global bucket that reduces dependence on one country and one currency. There should be an inflation and real asset bucket that protects against the possibility that money printing, supply shocks, and geopolitical fragmentation reduce purchasing power. There should be a liquidity bucket so that you are not forced to sell good assets at bad prices during a crisis, and there should be a process that keeps you from making emotional decisions when the world becomes noisy. The process matters more than the prediction. If you buy everything at once because a video scared you, you are not investing, you are reacting. If you gradually rebalance, gradually diversify, and gradually align your portfolio with the world that is emerging, you are behaving like a disciplined investor. The right question is not, should I bet against America? The right question is, should my entire financial future depend on America remaining as dominant in the next 20 years as it was in the last 20 years? That is a different question, and my answer would be no. Not because America is finished, not because the dollar is dead, not because China or India or BRICS will replace everything overnight, but because the world is changing and the price of being wrong about that change is high. When a system becomes more multipolar, flexibility becomes more valuable. When debt rises, hard assets become more valuable. When currencies are printed, diversification becomes more valuable. When valuations are stretched, price discipline becomes more valuable. When geopolitical risk rises, resilience becomes more valuable. That is the environment I see. I also see another risk that is more psychological than financial. Many investors have been trained by the last decade to believe that the winning strategy is simply to own the same handful of us mega-cap stocks and wait. That has worked extremely well. It may continue to work for some time. But when a strategy works for a long time, people confuse recent performance with permanent truth. They forget that leadership changes. They forget that valuation matters. They forget that currencies matter. They forget that the strongest country in one era does not automatically produce the best asset returns in every future era. In markets, the future rarely repeats exactly, but it often rhymes through cycles. Reserve currency cycles rhyme, debt cycles rhyme, empire cycles rhyme, capital flow cycles rhyme, market concentration cycles rhyme, and investor psychology rhymes. Most of all, people become most confident in a trend when it is most mature. They become most dismissive of diversification right before diversification becomes useful. They become most certain that the old world is permanent right before a new world begins to matter. That is why the current moment is so important. This is not the moment to be terrified. This is the moment to become more thoughtful. If you hold too much of your money in one country, think about whether that is a deliberate decision or just habit. If you hold no emerging market exposure, think about whether that is because you studied it and rejected it, or because the last decade trained you not to care. If you hold no inflation hedges, think about whether that makes sense in a world of large deficits, debt monetization pressure, commodity shocks, and geopolitical fragmentation. If you hold no cash or short-term liquidity, think about what you would do if markets fell and opportunities appeared. And if you are chasing every prediction about the dollar, stop. A good investor does not need to chase every narrative. A good investor builds a system. In my own mind, the system would be simple. Own productive assets, diversify across countries, do not overpay, protect against currency debasement. Keep enough liquidity to act when others are forced to react. Do not confuse the reserve currency of the past with a guaranteed investment return of the future. Do not abandon the strongest markets, but do not worship them either. The dollar's weakness, China's attempt to reduce dollar dependence, central bank gold buying, emerging market growth, and large institutional forecasts all point in the same direction. The next decade may not look like the last decade. That is the sentence that matters. It does not mean the next decade will be bad. It means the next decade may reward a different kind of preparation. It may reward investors who are global rather than provincial. It may reward investors who own real assets in addition to financial assets. It may reward investors who understand currency risk rather than ignore it. It may reward investors who see the shift early and make small, sensible adjustments before everyone else is forced to. I want to be very clear about something. No one knows exactly how this plays out. The United States could remain stronger for longer than the bears expect. China could have serious internal problems that slow its rise. India could disappoint relative to its potential. Emerging markets could underperform for years. Gold could sit still. Commodities could be volatile and frustrating. The dollar could rally during crises, even while weakening over the long run. All of those outcomes are possible. That is why preparation must be balanced. If the United States continues to dominate, a diversified investor still participates. If the dollar weakens, that investor has other exposures. If emerging markets outperform, that investor benefits. If inflation surprises, that investor has some protection. If the old order lasts longer than expected, that investor is not destroyed by being too early. That is how I prefer to think. Not certainty, robustness. The people who will suffer most from this shift are not the people who are wrong on one prediction. They are the people who never realized they were making a prediction at all. A person with 80 or 90% of their assets in U.S. stocks, U.S. bonds, U.S. dollars, and US real estate is making a very large bet. They may not call it a bet, they may call it normal. But normal is often just a bet that became popular. The world order that made that bet work is still powerful, but it is no longer unquestioned. That is the change. For decades, the dollar sat at the center of the system. Now more countries are asking how much they need it. For decades, the United States represented the safest default for capital. Now more capital is studying alternatives. For decades, American investors could ignore the rest of the world and still do very well. Now the rest of the world may become too large to ignore. This is not a call to panic. It is a call to stop sleepwalking. If you understand what is happening, you can protect your money and possibly benefit from the transition. If you do not understand it, you may spend the next decade wondering why the portfolio that worked so well in the past no longer works quite the same way. Markets do not punish people because they are bad people. They punish people because they are unprepared for changing conditions. A sailor does not control the wind. A sailor controls the positioning of the boat. That is how I think about investing in a changing world order. You cannot control the dollar. You cannot control China. You cannot control BRICS. You cannot control central banks. You cannot control oil prices, trade routes, or political decisions. But you can control whether your portfolio is built on one assumption or several. You can control whether you hold productive assets across different regions. You can control whether you have some exposure to real assets. You can control whether you keep enough liquidity. You can control whether you learn, adapt, and rebalance before the pressure becomes obvious. That is where the opportunity is. The biggest opportunity of the next decade may not come from finding one perfect stock or one perfect country or one perfect asset. It may come from understanding that the global system itself is changing and positioning yourself before the average investor realizes the rules of the old game are being rewritten. If America continues to lead, you should benefit. If the world becomes more multipolar, you should not be left behind. If the dollar remains dominant, you should be fine. If the dollar weakens, you should have protection. If U.S. markets keep compounding, you should participate. If international markets finally lead, you should participate there too. That is not fear. That is prudence. And prudence is one of the most underrated forms of intelligence in investing. The great mistakes usually come from arrogance, not uncertainty. People say the dollar will always dominate. People say the United States will always outperform. People say international markets never work. People say gold is useless. People say commodities are too hard. People say emerging markets are too risky. Every one of those statements may contain some truth in some environment, but no single statement should become a prison. The future will not ask what made you comfortable, it will reward what made you prepared. So when I look at the dollar today, I do not see the end of the world. I see the end of a certain kind of laziness. For many years, the system allowed investors to be lazy and still do well. They could own the U.S. market. Ignore currencies, ignore global power shifts, ignore debt dynamics, ignore commodity cycles, and still compound wealth. That may not be as easy going forward. The next decade may require a little more thought. It may require a little more global awareness. It may require a little more balance. It may require owning things that feel boring today but become valuable when the environment changes. It may require accepting that the strongest portfolio is not always the one that looks best in the last backtest. The strongest portfolio is the one that can survive the largest number of reasonable futures. That is the principle I would leave you with. Do not panic about the dollar. Do not ignore the dollar. Do not bet everything on one country. Do not abandon the country that still leads in many of the most important industries. Do not assume the past 10 years will repeat. Do not assume the next 10 years will be a disaster. Build for multiple outcomes. Think in cycles, respect debt, respect currency risk, respect valuation, respect diversification, and above all, remember that big shifts usually look slow until they suddenly look obvious. By the time everyone agrees that the world order has changed, many of the best adjustments will already have been made by those who saw the direction early. That is why this moment matters. The dollar is not dead. America is not finished. China has not won. Emerging markets are not guaranteed. Gold is not magic. Commodities are not simple, but the system is changing. And when the system changes, the investors who survive and prosper are the ones who see the change clearly, act calmly, and position themselves before fear forces everyone else to move at the wrong time. That is not just a market principle, it is a life principle. Reality changes whether we like it or not. The only question is whether we adapt to it early enough to benefit from it.